Welcome to this explainer. Today, we are diving into a massive, frankly mind-boggling financial paradox. Imagine this: some of the most powerful cash-rich companies in the history of the world suddenly having hundreds of billions of dollars in market value just wiped out. And by who? The very investors who usually cheer them on. We're going to unpack the nuts and bolts of this tech mystery, looking strictly at the data to understand exactly how the artificial intelligence revolution triggered a massive financial earthquake. Look at this number, 30%. Just let that sink in. Recently, absolute titans of the industry, we're talking Microsoft, Meta, saw their stock prices plunge by about 30% from their record highs on the Nasdaq. I mean, for companies valued in the trillions, a 30% drop isn't just a minor speed bump. It's a seismic event. It literally erases more wealth in a single afternoon than the entire GDP of several countries combined. But the craziest part is the context of when this actually happened. Which brings us to the core mystery we're exploring today. How on earth could these tech giants suffer such a massive stock pullback, especially when they were reporting incredibly high quarterly profits? Think about it for a second. Their traditional cash cows, advertising, cloud storage, were still printing money. Wall Street usually loves that, right? But instead, they got aggressively punished right in the middle of the biggest technological boom since the internet. It's a complete paradox. So let's look at the real culprit here: the AI arms race. You see, the foundation of this arms race is actually heavily rooted in the physical world. Massive tech firms, or hyperscalers as they're known because of their gigantic cloud networks, are locked in this fierce, almost desperate competition. To train the next generation of AI, they are buying hundreds of thousands of highly specialized processors called GPUs. And get this, we're talking about chips like the NVIDIA H100, which can easily run you $30,000 to $40,000 a pop. And no, you can't just plug these things into a standard wall outlet. These companies are building enormous sprawling data centers all over the world that are so power hungry, they're literally putting a strain on regional power grids. So we're not talking about simple software updates here. These are monumental physical construction projects. This introduces a really vital clue for us: capital expenditure, or CapEx for short. Remember those $30,000 chips, the massive real estate, the crazy advanced liquid cooling systems you need just to keep those processors from completely melting down? Well, CapEx is the hard cash drained immediately from the corporate bank account to build out this physical future. It's the money walking right out the door today. And that massive spending leads us right to draining the cash flow. So let's talk about free cash flow. As you probably know, this is the actual liquid cash a business has left over after paying its operating costs and, of course, those huge capital expenses. It's the lifeblood of investor returns, the cash used for dividends or stock buybacks. So when data center infrastructure costs go through the roof, like Microsoft reportedly forecasting up to $50 billion in CapEx for a single year, it's a direct hit to the company's free cash flow. It aggressively shrinks the actual cash on hand, even if their net income still looks totally amazing on an accounting spreadsheet. Well, investors took one look at the books and noticed a pretty disturbing internal transfer of wealth happening. The ultra-reliable, predictable profits from their established businesses, like social media ads and traditional cloud storage, were basically being drained. And what were they paying for? Unproven AI technology. The older businesses were essentially being treated like giant ATMs to fund this incredibly expensive AI experiment that, frankly, just hasn't fully paid off yet. And just look at this terrifying mismatch in scale. On one hand, you have total infrastructure costs ballooning into the multi-billions. We are talking tens of billions of dollars per quarter for these hyperscalers. But on the other hand, the AI revenue run rate, meaning the actual money coming in from users paying for AI, is just this tiny little sliver. They're dropping mountains of cash to build the infrastructure, but the actual demand from paying end users isn't even coming close to covering the bill yet. The gap between the billions going out and the millions coming in is just massive. Which naturally brings us to the Wall Street backlash. We can actually map the exact chain reaction that led to the crash. Step 1. Executives cranked up their annual capital spending forecasts to record-breaking levels, terrified of falling behind in the AI race. Step 2, thanks to those forecasts, projected free cash flow took a nosedive. Step 3, institutional investors completely lost their patience. On some of these tense earnings calls, you could literally hear analysts grilling executives, demanding to know when all this spending would actually turn a profit. Investors just refused to wait multiple years for a payout. They wanted cash-generating returns right now. And step 4, that sudden shift in sentiment triggered a massive sell-off on the Nasdaq, driving those share prices straight down. Now let's look at the real-world impacts.
Because this 30% drop isn't just numbers on a screen. It has a severe domino effect on the wider tech industry. And yeah, potentially your own wallet. First off, we're seeing aggressive strategy pivots. Hiring freezes, layoffs, specifically aimed at underperforming non-AI divisions like gaming or virtual reality. Basically, to feed the AI beast, everything else has to starve. Second, and this is where it hits home for you, expect to see higher software subscription prices. Think about the extra $20 or $30 a month companies are already slapping on for AI co-pilots and enterprise tools. They are trying to squeeze consumers to cover those massive AI bills. On top of that, it creates intense volatility in the supply chain for chip makers and developers. And finally, investors are having to suddenly reallocate their portfolios, yanking money away from future promises and parking it back in safe cash-generating businesses.
Finally, we have to talk about the looming economic risk. If this spending crisis isn't resolved, the broader risks are actually huge. First, sky-high memory and component prices mean every dollar invested buys less computing power, which absolutely tanks spending efficiency. Then there's the giant elephant in the room, the risk of overcapacity. If user demand for AI applications plateaus, these tech giants could be stuck holding the bag on billions of dollars of infrastructure they just can't monetize. It honestly draws some pretty eerie parallels to the telecom fiber optic crash in the early 2000s, where companies laid thousands of miles of expensive cable way before anyone actually needed the bandwidth. Plus, to keep funding this, companies might start racking up dangerous amounts of corporate debt instead of using organic cash. And ultimately, a severe, prolonged tech stock pullback doesn't just stay isolated in the tech sector. It can easily spill over and drag down the entire economic expansion of the broader financial markets. So that leaves us with the ultimate, multi-trillion-dollar question. Are these historic, massive capital investments laying the concrete foundation for a sustainable, revolutionary technological future? Or are we just watching a debt-fueled, speculative bubble driven by executive FOMO that is absolutely destined to pop? How that question gets answered is going to dictate the direction of the market for the next decade. Thank you so much for joining me for this explainer, and I'll catch you next time.